Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us. So, overnight, equity markets gaining globally, while on Wall Street investors digested the minutes from the Federal Reserve's September policy meeting, which showed majority support among members for an outsized cut to interest rates. Well, the major indices made solid gains, with the focus being on Alphabet, which fell after the US Department of Justice said it could force Google to divest part of its business, which include Chrome web browser and its Android operating system, in an effort to curtail its search monopoly. Shares of Arcadium Lithium soared when Rio Tinto struck a friendly all-cash takeover deal for the dual-listed producer for $9.9 billion. That deal gives Rio control of about 5% of the world's lithium supply, making it the third largest miner of the metal after Albemarle and SQM. Its US-listed shares were slightly lower on the news, while BHP also fell. Elsewhere, shares in Boeing dropped after talks between the company and its major manufacturing union broke down. And shares in Norwegian Cruise Line outperformed after Citi upgraded its rating to buy, which boosted its peers, Carnival and Royal Caribbean Cruises. And US-listed shares of Chinese firms fell as investors continued to question if China would announce further stimulus measures. Investors also monitoring for potential damage from Category 5 Hurricane Milton, which is about to make landfall in Florida. Well, the majority of US Federal Reserve members supported the beginning of the monetary easing cycle with an outsized half-point rate cut, minutes from the September meeting reveal. However, there was no commitment on the pace of future rate cuts. Dallas Fed President Lori Logan saying she wants smaller reductions ahead, saying we should not rush to reduce the Fed funds target to a normal or neutral level, but rather should proceed gradually while monitoring the behaviour of financial conditions, consumption, wages and prices. The US two-year Treasury yield rose to 4.01%, the 10-year climbing to a two-month high of 4.07%. Markets now pricing in a 75% chance the Fed funds rate will be cut by 25 basis points at the next meeting on November 7th, 2 days after the election. And the US dollar has edged higher to a two-month high ahead of that inflation data that's due tomorrow. The Kiwi dollar, one of the biggest movers, tumbling around 1.3% to 60.6 US cents after the Reserve Bank of New Zealand cut interest rates by 50 basis points yesterday. And New Zealand rates markets are priced in a 100% chance that the cash rate, now at 4.75, will be cut by another 50 basis points at its next meeting in November. The Aussie is at 67.2 US cents. A quick look at commodities. Oil prices have fallen after US data showed rising crude inventories, and Brent crude futures settling at $76 a barrel. Metals down across the board. Copper falling about 1%. Iron ore, little changed at $105 US a tonne. And gold has eased for a sixth session to $2,607 an ounce as that US dollar continues its ascent. Bitcoin back below 61,000 US dollars. Well, to get across those Fed minutes and also that looming threat from the latest hurricane in the US, I caught up with Ira Epstein from Lynn and Associates.
I read it and I looked at it this way. I think they're off base. If we get one more jobs report that's as strong as the one that we just saw that was released in September, we have a problem. Why is the Fed fighting inflation? That will be the first question, if it's not there because of jobs. So I want to phrase this the right way. If jobs stay strong and inflation isn't going up, why is the Fed cutting? That'll be the very first thing that I asked. If we're looking at the stock market in the US, it too responded that way. It looked at it that it's the best of all worlds. When I read the notes, you'll notice the market went up later in the session to all-time highs in the S&P and the Dow, because the market's saying this is just the best of everything. The Fed can either cut or not cut. But either way, the market's in great shape. We're going into an earnings season where everything's going to shift from rate cuts to are these companies making money? And if they're making money, hike, not a hike, but a cut, no cut, they're doing fine in this environment. I'm going to repeat. If you have a strong labor market, a lot of your problems are taken care of. And that seems to be the case. And if you cut rates, aren't you fueling inflation then? So they need to see weakness coming in labor, not strength, as they thought they were going to get. And they think that the CPI and PPI that are coming out on tomorrow morning and Friday are both going to be on the benign side. In other words, falling a little bit.
So, Ira, if you're in the Goldilocks zone right now, where do you want to be in terms of your investments?
Long stocks. This is the obvious place to be. If you're in the Goldilocks zone, we all thought that you would get a break in September that didn't come. Last week when I was on the show, I said, be careful. You generally end your breaks by October 10th if you go to history, and then you begin that pattern where bad news is good news and good news is good news, and everything tries to ultimately rally into year end. Now, it's not straight up from October 10th, but you're normally through with the worst of the bad part. Well, we didn't have a bad part in September. I mean, if you count intramonth, you had a 4.5% correction, but it's not how you ended the month up. And I always look at how you're ending the month up. And now we're going on for new highs. So any way you want to cut it, this market is back to the old business of the Fed's going to be your friend regardless. They're going to cut rates down the road regardless. I buy into that, by the way. That temporarily the labor market is stronger than we thought. I buy into that. And that we may have to pass a November cut and just go to December to get something done. And I can buy into that as well. How far off is that? The original, many people didn't think you'd get a November cut. I'm stuck back into that zone.
That's Ira Epstein. Well, for a broader look at what we're seeing at a macro level and how that's affecting investment decisions, I caught up earlier with Eric Souders from Payden Rygel.
I think the starting point is important. The starting point is one in which global growth is pretty good. Inflation has meaningfully come down the last couple of years, really across both developed and emerging markets. Labor markets largely normalizing, and central banks collectively are in easing mode as they're clearly prioritizing growth and any deterioration in employment over inflation. So we think, broadly speaking, the backdrop is supportive for risk assets. I think that, one of the key things here is that the trajectory of these factors is consistent in aggregate. But we are beginning to see some divergence. And so in areas like the US or in your local market like Australia, growth has been pretty good. But we are seeing some deterioration in growth in areas like Canada and Europe. So there is some fragmentation building on the growth side. I think the same thing can be said for employment. And so I think, for us, the result is the broad backdrop is supportive for equities and fixed income credit sectors. But we are keeping a keen eye on divergence. And I think clearly a really important theme that we're thinking about for 2025 is that inflation is dead. The market is pricing inflation as dead. We're not so convinced. But I think, again, zooming out, the backdrop is pretty irrefutably constructive right now.
Well, when we take a look at inflation, of course, we're going to get the read at the end of this week in the States. And this comes off the back of the minutes from the last Fed meeting where members there pointing out that there is no fixed path as far as those rate cuts are concerned. What are you seeing as the likely trajectory then of interest rates?
Yeah, I think, in the U.S., if you look at just where rates are priced today, you've got about 6 cuts priced into the U.S. market over the next 12 months. Now, it's fairly front loaded. Obviously, the Fed already went 50. The market's expecting 3 cuts in the next 3 meetings. So the Fed is front loading the cutting cycle, and they're clearly willing to go, and they want to continue to ease to the extent that they have validation to do that. Obviously, the latest jobs report has brought that into question a tad. So we think that pricing has become a bit more fair, Andrew, in recent weeks. A couple of cuts have been taken out of the rates market in terms of cutting expectations. We think near term, the path of least resistance is higher with respect to rates. And so, we tend to think that 3 cuts in the next 3 meetings is reasonably fairish, but I think that it's hard to argue that the path of least resistance is higher given the trajectory of data. I mean, we've seen a string of data the last couple of weeks in the U.S., and again, I think substantiated by the jobs report last week, that's been very good. And so, we would fade the number of cuts being priced in today. We think the long end is more vulnerable than the front end. Why? Because the Fed is really sitting on the front end, right? They're able to control the front end. And so we think it's the long end that's more vulnerable. You've got obviously persistent fiscal deficit in the U.S. Inflation expectations are quite low. And then who knows what will happen with the election in a few weeks. And so we think that setup is potentially vulnerable with respect to long end rates. But we would say the path of least resistance across the curve from here is generally higher.
So, Eric, given that, what's your strategy in regards to fixed income?
I think it's a pretty good time for fixed income. Nominal yields and real yields, whether you look at either of those things, which we do, we look at both, they're pretty elevated relative to, the couple of decades pre-COVID. They're not so elevated if you go back to the 90s and 80s, but, I think it's a pretty good time for the fixed income market just in terms of your running yield. We think that credit markets look good. I think that the probability of recession has gone down pretty significantly from our perspective in the last few weeks. The Chinese announcement is just another boost for sentiment. We'll see how that plays out. But I think, from a bond standpoint, especially on the credit side, we think things look pretty good, even though valuations are fairly tight. We always joke valuation is not always the best timing tool. So, we'd say that the bond market looks good, credit looks good, consumer-facing areas we think look good in particular, areas like housing, areas like commercial real estate, certain parts of it, we think look pretty interesting.
We just saw some images of China there. Of course, that has very much been in focus given the stimulus measures that have been unveiled. But of course, this week, markets are expecting to hear a little more. That didn't eventuate. What's your view about what you're seeing out of China at the moment?
Yeah, I think China's shifted clearly from prioritizing fiscal discipline and moral hazard to prioritizing political pressure associated with what appears to be just a deeply concerning housing market situation and quite high unemployment in the younger population within the country. And so I think the market, and we've already sort of seen this, Andrew, to your point, the market's been a bit disappointed by some of the initial numbers and signals. But China's seen this story before. I mean, we've seen this story in the U.S., we've seen this story in Japan, which is a private sector delevering, particularly one that's driven by housing. Generally speaking, cannot be solved with monetary measures alone. And the public sector needs to really step in. So I think China has drawn the line in the sand around that, and they've got a fairly large checkbook. So we think it's material. It's going to take time to play out, but we do think it's a regime shift. We do think it's important for sentiment. We've already seen a pretty big bounce, obviously in the Chinese local market, but also commodities in general. So you have these things coming together where developed markets are doing fine. Developed market central banks are easing, and now they've changed their posture. So we think that's just going to add more fuel to the global growth tailwinds.
So how investable is China right now then, Eric?
Yeah, I think we're not looking to invest in China directly. I think we're looking at some of the tangential things. So emerging markets, broadly speaking, we think look pretty good. Emerging market growth ex-China is running north of 4%, which is wonderful, given China's really been the harbinger for growth in emerging markets the last couple of decades. So the fact that EM is growing without China, growing at a kind of high single-digit clip, we think is very encouraging. Inflation is well contained in emerging markets, and actually fiscal austerity is a thing in EM. So emerging markets, broadly speaking, are much more fiscally disciplined than developed markets. And then, of course, we think that the commodity complex, there's just bullish tailwinds here with this Chinese announcement. So you put all that together, we think EM looks pretty good. Commodity exporting areas like South America, we think look good. Areas that are more proximal to the U.S. from a trade standpoint, like Mexico, also look pretty good. So I don't think, Andrew, we need to invest directly in China to get the benefits of this announcement. I think we're looking at kind of the second order effects.
Eric Souders from Payden Rygel. Stand by. The Open is just a minute away.